Good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Now, the dollar strength continues to persist in the market with the latest pressure coming in from the Chinese yuan. The yuan slid to a 10-month low of 7.35 in today's session. The dollar index itself hit the 105 mark in yesterday's trading, and we are seeing it hold on to right about those levels. What are you making out of the current market situation, JK? Yuan slide will continue to put pressure on rupee. What's your sense?
Yes, of course, rupee has more than just the yuan issue to contend with because we have a plethora of negatives which is putting the pressure on rupee, like the FII flow itself. It has turned quite negative this month. And this is after a string of months when we had large flows, and so that's happening at a time when there is outflow also, and demand is good, and exporters seem to be waiting for either to get a signal of rupee having seen its worst, or at least for some inflows to hit the market. So we have a situation where it is one-sided, and only RBI supply is taking care of the rupee not breaking into new lows. And definitely yesterday also we had seen RBI offering dollars at 83.20, and of course the buying remained consistent also. The weakness of yuan, as I said, definitely has impacted, and today we had seen the yuan retest the 7.35 levels, and it is trading there only. Yuan fixing was somewhat, I think, the weakest since 2007 as well, and that's another factor. Now, for rupee to turn around, we need either a big flow or a move back down in the dollar index, or an effective push down in the Chinese yuan, which is not on the horizon. So I expect rupee to continue trading on the weaker range. Whether it will break 83.30 depends entirely on the central bank. On this global side, of course, the global trade recession is continuing. As we saw evidence from Chinese data yesterday, export falling 8.8% and imports falling 7.3%. The net trade balance itself was also down by about 12 billion. Another reason why yuan bears got the confidence to retest the resistance at 7.35 again. Now, imports have been falling every month since every month in 2023, and exports have fallen year on year for every month since April this year, as global demand for Chinese goods have waned. Now, significantly, Chinese overall trade with US has also been on a steady decline, both exports and imports, which reflects the ongoing trade war between the two countries. On the other side, we also have the tale of two contrasting economy continuing. US Fed's steep increase in interest rates appears to have succeeded in guiding inflation towards their target. Inflation is remaining around 3%. At the same time, we also have the employment sector, which is still showing some strength. And also we have the unit labor cost today, which was higher, and contrast this with the European numbers, where the GDP growth in Eurozone was just 0.1% for April-June period compared to previous 3 months. The latest figures show that economic activity has been tapering. We had the Germany, Italy, and France, which make up for half of the entire GDP in the Eurozone, have been quite tepid. Germany suffered 0.1% contraction on a yearly basis and stagnated. Italy's GDP grew by just 0.4% on a yearly basis compared to 1% last year. And of course, France managed to grow by about 1%. So compare this with US growth, which was around 2.4% as per the latest estimates as well. The data from US, of course, ideally should have pushed the yields up, but yesterday seems to be the day when the bond sellers had wanted to take profit. So when the unit labor cost and the jobless claims came on the bullish side, we still had the yields falling, particularly on the 2-year yield. It fell by 7 basis points, and 10-year yield, of course, fell by 3 basis points. The long end 30-year bond yield was somewhat stagnant. But the stock markets had twin, challenges. One is the Apple, rather the iPhone usage ban in China, which is getting expanded to more and more users. It had a big pressure on Apple, Apple share price, and that put pressure on the Nasdaq as well. Overall, Dow, S&P also closed lower. Looking at the unit labor cost and the jobless claims, which are lower, again, fears of inflation are rising. And we all know that the crude prices have pushed above 90. And in fact, globally, inflation pressures may re-emerge because the crude prices have been pushing higher, even as the demand has sustained at a higher level. Therefore, this is not a good news for stock markets, which are actually been richly valued. Therefore, you expect stocks to be under some pressure, and the overall risk sentiment also to be subdued. Overall, on the currencies, euro did push to a new low for the cycle at 1.0685. Of course, the break of 1.07 has not been sustained. There possibly some profit taking ahead of the weekend, after having pushed quite about 4% lower from the previous, 4 to 5% lower from the top that we have seen recently. Dollar index also. There is some verbal statement from Japanese authorities which indicate they are watching the market very closely. While we are not seeing any action, their words mean that they are concerned about the yen weakness, and or at least they want to keep the yen from moving one way. So that actually put some pressure on other dollar against other currencies as well. Significantly, the commodity currencies like Australian dollar and Canadian dollar have been holding at their at the lows and not breaking down so much, despite the weakness in Yuan. So maybe some sense of dollar being quite long positions among the traders is weighing on the currency. Of course, we have a crucial inflation number from US next week, and there are indications that this number can come higher. Sterling, of course, played different card because the reports indicate that UK inflation will fall quite a bit in the next month report, or the report that is coming up in the next week. So there was a mixed performance from the currencies against the dollar. I mean, that's not really going to influence the rupee to any great extent. We still continue rupee to trade. We continue to see rupee trading between 83 and 83.30. Overall dollar, maybe the fall, or rather the fall in the other currencies or the rise in the dollar might be slowing down a bit because of the threat of intervention from Japan and Chinese yuan at a very crucial level, and also euro finding some support due to slightly short-term oversold conditions. We look to a very light data day today, but next week should be quite busy for us. So look for some range trading day ahead today. Thank you.
Thank you, JK, and that was very well summarized. When it comes to rupee, we have a plethora of negatives. FII flows turned negative this month, post a string of large flows in the previous months. But as of now, RBI's supply is taking care of rupee not breaking into new lows. At the same time, if you look at the theme, yuan fixing was weakest since 2007 as well, but even yuan is at crucial levels, and even the Japanese yen, where the risk of intervention in both these currencies are there. So maybe a combined intervention of all three central banks can have some sort of retracement in dollar, but we'll observe how that goes. Global trade has been under pressure as well, as we observe fall in both import and export for the Chinese economy. And when it comes to I really like what JK said, a tale of two economies. There is a contrast. Eurozone economies GDP numbers were either contracting or right around the 0% mark, while in US we had a GDP growth of over 2%. So a very stark difference over there. Globally, inflation pressures may re-emerge as oil prices also start moving higher. We will keep observing the same. We have a crucial inflation data next week for the US. So we'll keep track of the same. That's it from us today. Thanks for listening. Tune in next week for another round of fresh updates. Thanks for listening.